Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, so let's set the scene. Imagine you're running this huge publicly traded company, a real giant.
A conglomerate.
Exactly.
Yeah.
You've got dozens of business lines, you're in all these different markets, but the stock price is just flat.
Yeah.
It's not moving.
And investors are starting to ask that really tough question.
The brutal one. Why isn't all this scale, all this diversification actually being reflected in our value? Why aren't we worth more?
And that's the moment, that exact moment when the conversation inside the boardroom turns to corporate separation, to spinoffs.
Right.
It's one of the most powerful tools in corporate finance, but it's also, widely misunderstood because it's a total paradox.
How so?
The core idea is that sometimes by deliberately breaking a business apart, you actually create value, a lot of value. The pieces become worth way more than the original whole.
It sounds completely counterintuitive.
Oh.
But it happens.
It happens all the time.
So that's our mission for this deep dive. We're going to unpack this for you. We'll get into why companies do this, how the finance teams even begin to analyze such a massive decision.
And we'll look at the real-world results. I mean, cases where these splits created billions and billions in new shareholder wealth.
Let's start right at the beginning. What exactly is a corporate spinoff?
So in simple terms, a spinoff is when a parent company takes one of its business units, one of its divisions, and separates it into a brand new, totally independent, publicly traded company. It's a clean break.
And the key part for investors is how they get a piece of this new company, right?
Exactly. The shareholders of the parent company, they just automatically receive shares in the new entity. And critically, it's usually structured to be completely tax-free for them.
So it's not just some internal shuffle. It's like taking a whole department, one that used to share everything, HR, IT, debt.
All of it.
And you just launch it as its own company with its own CEO, its own board, its own unique strategy.
But you wouldn't go through all that chaos unless the payoff was huge.
Right. So what are those big strategic drivers? What's the why?
The sources really point to 5 main reasons, and the first one is by far the biggest. It's the drive to unlock what we call hidden value.
The famous conglomerate discount.
The conglomerate discount. It's this penalty the market applies to highly diversified companies.
Why, though? Why a penalty?
Because investors struggle to value the mix. They see a slow growth, steady business mashed together with a high growth, maybe risky tech business, and they can't put a clean multiple on it, so they discount the whole thing.
And the classic example here has to be eBay and PayPal.
Absolutely. PayPal was the rocket ship inside eBay. High growth, amazing margins.
But it was stuck. It was being valued like a slower online marketplace, not the fintech innovator it actually was.
Right. Its value was being held down by eBay's more modest valuation multiple. The spinoff was the unlock.
As soon as it was its own company.
The market could value it for what it was, a high-growth tech stock. Its valuation just skyrocketed. And not only that, it got the freedom to partner with eBay's competitors.
That's a huge point. It could suddenly work with Amazon or anyone.
That freedom was worth billions. It wasn't long before PayPal's market cap was bigger than its old parent company, eBay.
Which leads right into the second big reason, strategic focus.
Yes. Different businesses have totally different needs.
The way you invest capital, your product cycles, your appetite for risk, it can all be in conflict.
The recent J&J and Kenvue split is a perfect example of this.
J&J's consumer side, so Tylenol, Band-Aids, Aveeno.
Right. A massive, stable business that needs steady investment in marketing and supply chains. It's predictable.
But its other half, the pharma and medical device side, is the complete opposite.
Totally. That requires huge, long-term, very risky bets on R&D. By spinning off Kenvue, J&J could tell a much cleaner story to investors. We are a high-margin breakthrough science company, and Kenvue could focus purely on being a top-tier consumer goods company.
Okay, that makes sense.
Yeah.
The third driver is where we get into the real financial engineering, right?
Yeah.
Capital structure optimization.
This is a massive lever for creating value. A big conglomerate usually has one sort of blended capital structure for everyone.
One size fits all.
Pretty much. A spinoff lets you customize the balance sheet for each business.
So the high growth part might need almost no debt to stay flexible.
Exactly. A clean balance sheet to fund its expansion. Meanwhile, the mature parent company, the cash cow, can actually take on more debt.
And they also do, don't they? They'll issue a bunch of debt right before the...
They do, and then they use that cash to pay out a huge one-time dividend to shareholders. It's an immediate return of capital, and it keeps all that debt away from the new high-growth spinoff.
And I imagine the last couple of reasons are more external.
They can be. Reason 4 is often regulatory or competitive pressure. Sometimes antitrust regulators will force a breakup.
Or activist investors.
Or activists, yes. They'll come in, buy a stake, and argue that one division is dragging the whole company's valuation down, and they force management to spin it off.
And the 5th reason is just getting ready for a sale.
Right. It's a step 1 divestiture. It's much easier to sell a clean, standalone company than it is to sell a messy division that's all tangled up in a larger corporation.
Okay, so we have a clear picture of why companies do this. But that brings us to part 2, which is the how. And this is where, the operational chaos seems to begin.
No, it's incredibly complex.
This isn't just a strategy memo. It's months, sometimes years, of really detailed work. So what are the biggest hurdles the finance teams have to overcome?
The very first one is just assessing the standalone financials. These businesses were never run on their own. They shared everything.
Legal, IT, the C-suite.
Everything. So you can't just look at the old profit and loss statement. You have to create what are called carve-out financials.
Which sounds like you're building a whole new history.
You are.
Yeah.
You're reconstructing what that business would have looked like if it had always been on its own. Projecting revenue, margins, capital needs, and the big one. Can it generate its own cash flow?
So the key question you're trying to answer is, will investors give this new company a higher valuation after we pile on all the new costs of being a standalone company?
That's the billion-dollar question, and it leads right into the biggest operational nightmare, disentangling shared costs.
Okay.
All those services, HR, finance, IT, they don't just split in half cleanly. You have to reallocate everything. And the real danger here is something called stranded costs.
Stranded costs. Define that for us.
A stranded cost is an expense the parent company is stuck with after the spinoff is gone.
Uh-huh.
Think of a 10-year lease on a giant corporate headquarters that is now half empty, or a massive software license for 10,000 employees when you now only have 6,000.
So these are costs that were supporting the old, bigger company, and now the parent is just left holding the bag.
Exactly. And those stranded costs can eat away at the parent's profitability, and they can completely destroy the value you thought you were creating.
Which is why those temporary agreements are so important, the TSAs.
The transaction service agreements, yes. They're like temporary lifelines.
Where the parent agrees to keep providing, say, payroll or IT support to the new company for a year or two.
Right, for a fee, while the new company gets on its feet and builds its own systems. They're necessary, but they're also expensive and complicated.
And beyond the operations, there's the big negotiation over debt and capital. Who gets the cash and who takes the debt?
It is a high-wire act. The parent company often wants to load up the spinoff with debt to clean up its own balance sheet.
But the spinoff needs to be healthy.
It does, especially if it's the growth engine. So usually the parent keeps most of the debt, allowing the new company to start with a pristine investment-grade balance sheet so it can fund its growth plans.
And then looming over all of this is tax.
Yeah.
The whole thing hinges on those new shares being tax-free for investors.
It absolutely does. And this is where the complexity just goes through the roof. In the U.S., you have to follow very strict IRS rules.
This is the Morris Trust stuff I've read about.
That's the one.
Yeah.
It's a set of doctrines that govern these things. The parent has to prove it's still an active business. It has to have owned a certain percentage for a certain time. And crucially, it puts major restrictions on what can happen after the spinoff.
So wait. If the new company, the spinoff, immediately turns around and gets acquired,
which is often the strategic goal.
That could retroactively blow up the tax-free status of the original deal.
Precisely. It can trigger a massive catastrophic tax bill for the parent company and its shareholders. Hundreds of millions of dollars gone. It destroys all the value you're trying to create.
Wow. And then I guess you have the softer factors too, like just making sure the market understands what this new company is.
Market signaling, yeah. You need a clear, compelling story that attracts a new set of dedicated investors and analysts who will cover the stock properly.
It is just stunning how many things have to go right. So let's connect this back to the real world. Let's look at some of those famous cases where it all came together.
Well, we have to go back to PayPal and eBay. The value unlock wasn't just the higher stock multiple. It was freedom.
Freedom from having to serve only eBay's marketplace.
Right. PayPal could suddenly go partner with Amazon, Visa, MasterCard, anyone. It could focus 100% on mobile payments and global expansion. That's what unleashed its true potential.
Another huge one was the breakup of Hewlett-Packard.
Into HP Inc. and
Right.
HPE.
That was a split based on totally different business models.
Yeah.
You had the PC and printer business,
HP Inc., low margin, high volume, very fast consumer cycles.
and on the other side, the enterprise business, HPE.
Selling complex hardware and services to big corporations. Long sales cycles, high margins, they were just too different to live under one roof and one capital allocation strategy. The split let each one focus on what it does best.
And we saw a similar logic with IBM and Kyndryl, didn't we?
We did. IBM desperately wanted to tell a growth story.
About cloud, AI, high-end software.
Exactly. But they were being weighed down by their legacy managed infrastructure business, which was huge but slow growing. Spinning that off as Kyndryl instantly made IBM look like a cleaner, more focused tech growth play to a whole new class of investor.
And it's not just tech. The split of Kraft and Mondelez was about geography and product.
A classic case of diverging strategies. The plan was for Kraft to be the stable North American grocery business.
Focused on efficiency.
Right. And Mondelez would be the aggressive global snacks company, focused on emerging markets and acquisitions. You just can't run those two strategies with one leadership team and one budget.
We've seen this play out over and over. I mean, PepsiCo spinning off its restaurants, Taco Bell, Pizza Hut, KFC, into Yum Brands.
The perfect example.
Yeah.
Running restaurants is a real estate and franchise management game. It has nothing to do with selling soda and chips in a grocery store. They needed their own capital and their own focus.
And maybe the most ambitious was the Dow-DuPont deal.
That was incredible. A massive merger with the explicit pre-planned goal of then breaking up into 3 separate, highly focused companies.
Dow for materials, DuPont for specialty products, and Corteva for agriculture.
It showed that sometimes a merger is just a means to an end. The real goal is the strategic clarity and focus you get from the eventual separation.
So when we pull this all together, what's the core lesson for us as we watch these massive corporate moves?
I think the lesson is that spin-offs are really a masterclass in corporate finance. It's not one thing. It's valuation, it's capital structure, it's tax law, it's operational execution, all at once.
And it's incredibly high stakes.
The ultimate high-risk, high-reward bet. You get it right, and you can unlock billions in value that was trapped inside the company. You get it wrong, miscalculate the stranded costs, mess up the debt allocation, and you can create 2 weaker, struggling companies.
So the success or failure really does come down to the quality of that initial analysis.
The quality of the analysis and the precision of the execution.
I think that's the key takeaway for you, the listener. When you're looking at a huge company, especially one when the stock isn't going anywhere, just remember, sometimes a part of that business isn't underperforming because of bad management.
Not at all.
It might be underperforming simply because it's being held back. It's being constrained by the parent company's strategy, its cost structure, its identity.
That's exactly right. And I guess the final provocative thought to leave you with is this. When you look at some giant, diversified company, consider that its best path to real explosive growth might not be to buy something new.
But to break something off.
It might be to strategically plan its own demise and grow by breaking itself apart.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.